Hello guys, Michael here. In today's video, we will be again talking about the strategy that includes Bollinger Bands, but in the opposite of the previous video, instead of talking about the ways to use the Bollinger Bands in order to ride the trends, the beginning of the trends when the volatility starts to getting higher, so the moments when the bands are starting to expand, we will be talking about the very good strategy, a very high profitable strategy that you can use in moments when the bands are in very tight range, when they are contracting, therefore when the volatility is much lower. So without further ado, let's jump into the platform and see what we've got. Okay, so we are in the trading platform, and first things first. This is the chart of British pound against Japanese yen, the currency pair. And firstly, of course, we need to add the Bollinger Bands, whether the default settings, which is 22 and 0. So next thing, we will add another very popular indicator, which is a stochastic indicator. Also with the default settings, which is 14, 1 and 3. So you don't need to almost change anything in those indicators, except in the stochastic, the overbought and oversold zone I changed from 80 to 70 and from 20 to 30. So I am talking about those two lines which are detecting for you the oversold and overbought zone respectively. So the strategy goes as follows. It is very simple as usual in those kinds of videos. So we are trying to enter short when the price is at the upper Bollinger Bands and the stochastic is giving us the signal of the crossing of the crossover signal at the in the overbought zone. But as always, we need to take only sell signals in the downtrend and the buy signals in the uptrend. But how to identify whether we are in an uptrend or downtrend? Here you might say that clearly this is an uptrend. We have the upward move, we have higher highs, higher lows, so on and so forth. But if you, for example, zoom out the chart, you could say, not necessarily we are in a downtrend, because, for example, when we look from the bigger perspective, this is higher high than this high. So if we draw a line from here, we could say that more or less we might be in a downtrend, right? So how to identify this? The simplest way we can use is, of course, another indicator, very popular one, which is the moving average. And I know they are laggy, they aren't, we can say, perfect, but we need to have some sort of a, we can say, indication of whether this is a downtrend or uptrend. It will not be perfect, but for us it will distinguish the moments whether we should look for trades or whether we should look for buy or sell trades. So therefore, let's add the 200 period moving average, which I already did. This is an exponential moving average. So it is clear for us that when, let's zoom in, when the price is above 200 period moving average, we are looking only for buy trades. Therefore, we will be only looking for opportunities when the price is at the lower Bollinger Bands. Okay, so now let's discuss a couple examples of shorts and long trades. So let's now discuss maybe this example over here where we have a short signal. So firstly, what we need to do is to, of course, identify that the price is below the 200 period moving average. Therefore, we are looking only for sell trades. Second thing is that we see that the price is at the upper Bollinger Band and the stochastic gave us signal with the crossover. So this blue line crossed the orange line from the top to the downside, and therefore this is for us the trading signal for entry in short trade. So when let's check it right here at the closing of this candle, this moment happens. We had this crossover. So right here we are entering in the position. So at the closing of this candle or opening of this one, doesn't matter. So as for the take profit and stop loss, very similar to the most of the strategies that I discuss on this channel. So we are setting our stop loss at the recent high, the nearest high, which is above, slightly above. Let's maybe even make it bigger. Slightly above this candle. So we have at this point 41 pips, and the risk reward, of course, we are using most often 2-to-1 as it is in this situation. So 2-to-1 risk reward ratio. This example was a profitable one, so we have 83 pips. But as we also discussed many times, we are most often setting the constant percentage risk from the deposit, and from that moment we are calculating our risk according to the stop loss, which means that the position size will always differ because the stop loss distance always differ from the trade to trade. So if we have, for example, 10,000 in our account, we are, for example, risking 1% of our account per each trade. Therefore, always our stop loss will result in risk of $100 and potential gain in $200. So it doesn't matter how much the distance is from the entry to the stop loss. You will always calculate it with the position size calculator to adjust the volume accordingly to your risk management. Therefore, it should always be $100. So this is the first example of sell trade. Here we could have another example. This one might not be profitable, but let's check it either way. Still, over here we reached the upper boundary. Still, we are very close to the upper boundary of the Bollinger Band. And at the closing of this candle, we received the crossover at the stochastic indicator. So you can clearly see that here we are still at the upper boundary of the Bollinger Band. And at the closing of this red candle, as you can see here, the stochastic gave us the crossover signal in our overbought zone, adjusted overbought zone. So now let's delete the drawings and set our trade. So we are entering here or here, doesn't matter, it's the same position. So this is our recent high, so we are adjusting our stop loss slightly above this high. Most often I am adding 1 pip plus the spread and commission. So you need to calculate it according to your broker, because each broker will give you different trade conditions. So, and as always, we are adjusting 2-to-1 risk reward ratio. So this one most likely would be not profitable example, or no, it would be profitable even twice, because here there is another signal. So as you can see over here, this example was also profitable. So these are two examples of sell trades. Right now, let's go further down the line and check other examples. So as you can see, this one is the signal is from the stochastic, but we have some distance from the upper Bollinger Band. But over here we even cross the Bollinger Band slightly, and at the closing of this candle, if we would zoom in, you can see that at this moment we received the crossover, so we could enter at the opening of the next candle, which is over here. So as you can see, this candle was the trigger one because we received the crossover over here. If you will zoom in, you would spot the crossover over here. So let's remove the drawings and set our position. So we have the entry over here, stop loss slightly above this recent highs, which gave us 13 pips distance, which is a very tight range. And you can clearly see that this one was also profitable, even with the bigger risk-reward ratio, but let's set 2 to 1 risk-reward ratio. Okay, it's 2.09, 199, fair enough. So as you can see, even with the first candle, we already received our profit. And right here, also, you should adjust the volume of the trade. If we have 13 pips stop loss, you should adjust the volume to be that high that in this trade also you should risk $100, 100 euros, or whatever is your deposit in whatever currency, whichever currency you had the deposit. Therefore, in this situation, you could also obtain $200 in profit. So these are examples of sell trades. Here we are at the 200 period moving average. So now let's look for the examples. Here this one could be also profitable. Yeah, this strategy is very good. At the end of the video, of course, I will share with you the details as for the results. So maybe let's discuss even this one, this short example, which most likely is not profitable, but let's talk about it either way. So we are above the 200 period moving average. This is a green line. And you can clearly see that we are in the oversold zone on the stochastic. At this candle, the crossover is very clear. So we could enter at the opening of this red candle. So once again, you can see that at this candle, the crossover clearly occurred. Okay, let's again remove the drawings. And let's mark our position long this time. And we are setting our stop loss slightly below the nearest lowest point, which is over here. So, of course, let's set 2 to 1 risk reward ratio. Okay. Yeah, might be. And in this example, this was a loss trade, but slightly we didn't manage, slightly a couple pips was lacking to fill the trade in profit. Okay, so now let's look for other example of a buy trade. So we need to look for the moments when we are above the 200 period moving average. And yeah, let's discuss either if it is a profitable example or not profitable example. Maybe this one's over here would be good 2 examples. So the first one will be, from what I can see, will be a loss, but the second one will be a profit. Okay, so this we should also talk about not only gains, but the situations that you might occur in the real market. So the losses are also worth mentioning and discussing. So let's talk about those 2 examples. Firstly, we see even previously, but okay, let's discuss these 2 ones. So we have the situation over here. We are on the lower Bollinger Band. The stochastic over here at the closing of this candle, if you would zoom in very closely, right here, which is the closing of this red candle, which is here, this level, the crossover occurred. and gave us the signal for a buy trade because we are above this green 200 period moving average. So we are entering, so once again, this candle was the trigger one. Here you can see at the stochastic, and we are entering at the opening of this green candle. So let's remove the drawings once again. Let's zoom in to see better this example. So let's take a long position. We are entering over here, and we are setting our stop loss slightly below this red candle, which is 5 pips in this situation, and our profit target is risk reward ratio 2. Oh no, this one would be, this one is in fact a profitable one because we received a profit at this the first candle at the moment where we opened the trade. So okay, either way, because here there were a couple trades that, for example, this one, which was unprofitable one, but okay, doesn't matter. Let's talk about this one that we choose. So that's the first one. This one was a profitable example, and here we have another situation over here, because as you can see here, the line just touched, they didn't cross, the blue line was above. Right here another crossover occurred to the downside, and the signal occurred at the closing of this green candle. So again, we are at the lower Bollinger Band, the lower boundary, and as you can see, at this green candle, at the closing of this candle at this level, the crossover occurred. Wait, what is it? Why is this? Okay, more or less you can see we are talking about this moment here, this candle. So once again, remove the drawings. So we are entering at this level, which is, it might be opening of this candle. So let's mark our trade, and we are setting our stop loss slightly below the nearest lowest point, which is the low of this candle, which is over here at this point. So we are adding pip or two to the distance, to our stop loss, and we are setting our target risk reward ratio 2 to 1. So it will be, oh, this example might not be profitable, but no, it should be. Yes, I guess it will be. So we have 2.02, and yep, under this candle our trade cashed a profit. So you can see it over here. Stop loss slightly above the nearest low, risk reward ratio 2 to 1, and at this candle our transaction was filled with a profit. So now let's discuss the stats of this strategy. So once again, as a reminder, this is the currency pair of British pound against Japanese yen, 1 hour time frame. So each candle represents the 1 hour price change. And now let's check the stats. Give me a second. So for 100 trades backtest, the win rate is 56%, which means on 100 trades, 56 of them was profitable. If we would trade with the 2 to 1 risk reward ratio, which means we would risk every time 1% of our deposit in order to obtain 2% of profit, it would bring us 68% profit, and the time frame of this was around 8 to 9 months. So yeah, I guess 60 to 70% into 3 quarters of a year, 8 months, we can say 8-9 months, is I guess a very good profit. It would yield us almost 100, slightly below 100% for a calendar year. Another thing that I want to mention is that this strategy works very good in the moments of lower volatility. As you can see over here, for example, when we have the lower volatility period, and when the higher volatility period starts, the moments that we discussed more broadly in the previous video about the Bollinger Bands, which you can also check on this channel in the playlist, you can utilize the strategy from the previous video, which is better suited for the moments of higher volatility. And when there is a low volatility, you can use this one, which is a combination of the Bollinger Bands, 200 period moving average, and a stochastic indicator. So you know the stats, you know the utility of this strategy. I think this one is the best utility of a Bollinger Bands you can find. If you have any more suggestions, I would be very pleased to know them. So if you have them, if you could, leave them in the comments or write me directly in the LiteFinance social trading platform. I would be happily to to check what are your observations on this topic. So that would be all for this video. Thank you for watching, and till next time, guys. Bye.